Welcome to the daily briefing from interest.co.nz. I'm Bernard Hickey, filling in for David Chaston. Today we look at the government's latest spending and revenue figures and find both taxation and core government spending is growing much faster than the rest of the economy. Then we'll look at the extraordinary success so far of KiwiSaver, where new figures show more people have signed up than everyone had expected. And finally, we'll round up the latest news about interest rates here and overseas, including the Bank of England's decision to cut rates last night. It's worth delving a little deeper into the government's latest disclosures on spending and taxation to find out just how fast the state sector is growing. Figures for the first 4 months of the fiscal year to the end of October paint a picture of a government growing fast just at a time when the economy is stretched in terms of inflation and unemployment. The government's operating balance, which is a bit like its profit and loss statement, shows a surplus of $2.69 billion for the first 4 months of the fiscal year. That's up 4.5% on a year ago. But the real story is inside both spending and revenue lines. They show total core Crown spending grew 9.6% in the first 4 months of from the same period a year ago. That means government spending is growing almost 4 times faster than economic growth. Now the big culprits are health, social security, education and the core bureaucracy itself. Health rose 11.1% to $3.7 billion. That's pay increases to nurses and the effects of an ageing population. Social security rose 5.8% to nearly $6 billion. That's despite record low unemployment. Working for families is helping inflate that number. But the most interesting one is core government services. That's bureaucrats and the ministries in Wellington. That rose 7.7%. Meanwhile, on the other side of the ledger, tax revenues are up 4.8% to nearly $18 billion. Thanks again to rising wages and the effects of fiscal drag, where more people are being caught by the higher rate and more of their income is being taxed at that higher rate. The tax take is therefore growing twice the rate of economic growth. No wonder the Reserve Bank warned again yesterday that stimulation from greater government spending is pushing inflation higher. One area where the government's policies seem to be working is in saving. The much debated KiwiSaver scheme is turning out to be much more popular than many expected. Fresh figures out this week from the government show that now almost 1,250,000 workers have signed up for KiwiSaver. That's a stunning increase from just 250,000 a month ago. Remember, the scheme has only been going for 5 months and Treasury forecast 350,000 people would sign up in the first year. So we're almost at that level with more than 6 months left to go in the year. Interestingly, it is young Kiwis who are joining the scheme at a great rate of knots. That's surprising. The widely held view was that young workers would prefer to spend and borrow rather than save. So nearly 20% of savers in KiwiSaver are younger than 25. There's 33,000 people under 20 and half of the KiwiSavers are under 45. The big carrots of the $1,000 kickstart and $1,043 tax credit are doing the trick. That's great news for the national savings rate and should help the stock market. It will also take yet more money out of disposable incomes already hurt by higher mortgage costs and higher fuel costs. This renewed interest in investing in non-property assets comes just as the property market appears to be stalling and house prices have stopped rising in the big cities. This could be a difficult Christmas for retailers who depend on shoppers dipping into their disposable incomes or borrowing against the rising value of their homes to spend on big ticket items such as cars, flat screen TVs and holidays. And finally, we wrap up the week with the latest news from home and abroad on interest rates. Last night, the Bank of England cut official interest rates, surprising most economists who had expected rates to be held. Now, the central bank in London cut the official bank rate to 5.5%. The bank's governor, Mervyn King, cited worries about the credit crunch and its effect on consumer confidence in Britain. Remember, it was only a few weeks ago that savers were queuing outside of one of Britain's biggest banks, the Northern Rock, to take their money out. It's interesting that the rate cut came just a week after King said he was worried about inflation in Britain. Meanwhile, the European Central Bank, it held interest rates overnight at 4%, and the president there, Jean-Claude Trichet, actually said some within the bank had wanted a rate increase. It just goes to show how much of an impact the credit crunch is having in the Northern Hemisphere, particularly in housing markets where many of the mortgages were parcelled up and sold off to financial investors rather than kept within the banks. It is these bundles of mortgages that are unravelling and forcing massive write-downs. New Zealand obviously doesn't have anything like the same level of mortgage securitisation, and the home lending market hasn't seized up to the same extent. But the volatility overseas is a worry, particularly when New Zealand is still borrowing as much as $1 billion a month to fund its current account deficit. I'm Bernard Hickey, standing in for David Chaston. Join me again on Monday for the freshest finance news on the web, here at interest.co.nz.